Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Thursday, the 2nd of November, 1 o'clock on the East Coast. G Swizz here, Dan Nathan there, EY from SoFi, backstage. And if it's Thursday, Dan?
It's Butters. That would be John Butters. He's the senior earnings insight analyst from FactSet, and he's going to have a little preview for us of his earnings insight blog. That
if
drops.
It's Thursday, it's Butters. It drops on your inbox on Fridays, but we have access to it.
Yeah, we do.
Early because we're special. Rangers play tonight back home against the Canes, as they say.
Yeah.
Congratulations to the Texas Rangers.
How about that? First title ever, huh?
You know, there were 6 Major League Baseball teams that had not won a World Series. Now there are 5.
Yeah.
Padres of San Diego, Tampa Bay. A couple, we can rattle them off. Seattle, I believe Seattle. Doesn't matter. Let's look at the rundown. Why is the market higher? Because it's open. But you know what? What happens to stocks when the Fed stops hiking? Elizabeth knows the answer to that. I'm not sure I do. Apple tonight after the bell. Everybody's all geeked up. All the Apple bulls. You got to own it. Don't trade it. And the biggest stock moves of the day, without question, there's a lot going on here. A 30 basis point move in 10-year yields over the course of maybe 5 or 6 trading days, or maybe a couple more. Again, amazing what's going on. And I didn't anticipate that move of that magnitude. We had talked about 88.5, 89 or so, maybe in the TLT. But it's happened a lot faster than I thought, Dan. Here we are.
Listen, 30 basis points off a 4.9 handle or something like that on the 10-year. that is significant. And you can make the argument, guy, with the S&P up what it is right now today, that it should be up a lot more based on that. We're up 1.5%. We're up 64 handles here. We have an S&P that has quickly gone from 4,150 to 4,300. Let's pull up the chart here. We talked about this a little bit yesterday on Market Call. Since we've been in this downtrend from 4,600 from the highs in July, the S&P 500, a series of lower highs, a series of lower lows. We sliced through that 200-day moving average. If we go to the next slide, we did this yesterday here. We've had a couple of rallies. We had that one was, nearly 5% a couple months ago. We had a 4% one. Now we're in the throes of nearly a 5% one. I don't know, guy. The jury's still out to me, what if yields are to kind of firm up here a little bit? What if we are to get some hotter data tomorrow as it relates to the job? If we have the 10-year on its way back towards 4.75 in a snap, where's the S&P? Is it higher than here? I don't think so.
Yeah, well, the chart before, the one with the channels, this is the one you really have to look at because this down channel since July is still intact. You just said it, series of lower highs, a series of lower lows that has not been broken. In order for it to be broken, you effectively need to probably close up another 100 or so handles in the S&P. Personally, I don't see it getting there. Obviously, Apple is going to tell the tale later this afternoon. That could give us the much-needed juice to get through that downtrend line. I just don't think it's going to happen. So people were, clearly caught off sides in terms of the bond market. No question about that. I'm being one of them, although I did, again, we had a conversation with Carter earlier this week where we thought, yields probably are still going higher in the context of the up channel in yields. But with that said, you could probably see yields pull back down to sort of 455, 460. But again, I didn't think it would happen in 2 trading days.
Well, even you, who is a higher yields guy, you agreed with him that this is likely to happen. We're likely to get that sort of retracement. You see that, steady rise that we've been in from those lows, earlier in the spring or so. Before we get to Liz, I just want to pull up the NASDAQ chart. You just mentioned Apple after the close. To me, Apple obviously holds a key here. Like when you think about it, the largest equity in the world, the stock was trading down, I think at its lows last week, 15% from its July highs. Look at that NASDAQ 100 chart. Look where it bounced, okay? It was kind of that breakout level from earlier in the spring, the rising 200-day moving average, the same sort of downtrend that's been in place. So, we could still rally. The NASDAQ could still rally, pulled up by Apple and get to that downtrend, and it might not be on its, way back towards the highs in a way. So, again, I think yields have a lot to do with what happens next, that next 100 or 150 points in the S&P or the NASDAQ for that matter. Guy, thoughts on the NASDAQ here? Because again, the S&P is at the level. You know, it's at that 5% sort of rally. It's very near that downtrend that's been in place. But if it doesn't breach to the upside in the NASDAQ, I'm not convinced about the broad market.
No, I'm not convinced either. I mean, that move down coincided with Apple, I think, had a 165 print. NVIDIA traded sub 400.
Yep.
Yeah, so
400, yep.
So that was obviously part of it as well. I mean, a lot of these things sort of lined up for that move, and then we've seen a subsequent bounce on the back of lower yields. That downtrend is still intact. The level we stopped at makes sense. The downtrend is still intact. Can we trade up to it? I guess. But now we've created a little bit of a gap. But the next chart, the yields chart, is really the one that we've talked about and we should look at. I mean, this is the one we discussed with Carter the other day. Again, I was in agreement with him that, yeah, you could see a move back lower in yields, but no way in my wildest dreams I thought we go from, either side of 495 or so down below 4.7% over the course of 2 trading days. Again, it just goes to show you bond volatility is still alive and well.
Yeah, we had David Rosenberg of Rosenberg Research on our On the Tape podcast with Danny Moses. We recorded it just a couple hours ago. It's going to drop in your favorite podcast store tomorrow. Check that out. I mean, David, is pushing back at some narratives about yields. I mean, I think you guys are on a different side of the fence as it relates to it, but great conversation that we had with him. But I mean, listen, I mean, he thinks yields are going much lower, and he thinks that equities are also going to go lower. And so that was a really kind of interesting conversation with him. So check that out in your favorite podcast store. All right, guy, let's bring her in. This will be EY from SoFi.
Where is she today?
She's in. We don't dox here.
Oh.
We don't dox on the market call. You know what I mean? Who knows where she is?
Yeah,
but,
good point. We're not that.
But she's here with us, and that's the most important.
She could be anywhere with that fun little look at that backdrop.
Yeah.
She could be.
Isn't it great? I mean, somebody with you guys made this for me.
Yeah, well, that would be the Jacob probably. Liz, you spent a lot of time on your note that drops on the SoFi blog today on the Fed here. I just want to set up before we get to kind of some of your thoughts and takeaways from what you thought you heard from Fed Chair Powell, the market's reaction, the yield reaction, all that stuff. Our good friend Peter Bookvar over there at Bleakley Advisors on his book report that comes out every day, and he's breaking down a whole host of different macro stuff. He said this, and I thought this was interesting. If Jay Powell is now going to be intellectually consistent, the Fed is done hiking rates. If a tightening of financial conditions, aka the rise in the long-term interest rates, is the reason they are done for now, as he has basically said, really the only reason why he would see a notable drop in long-term rates is if the economy slows a lot, which is when the Fed could be discussing cutting instead. This is basically Rosie's take too, a little bit. So love to get your take on that, Liz, and how you're thinking about just basically what you heard yesterday and what's going on in the market since.
Well, I think, first of all, they can't confirm that they're done hiking rates because we're not at 2%. And the verbiage that he uses, which I wrote in my blog today, is something along the lines of they need to confirm that they're on a sustainable path toward 2%. They obviously do not feel like that is the case yet, so they're not going to take future hikes off the table. There's also always the risk of some sort of shock or just some movement in supply and demand that takes inflation back up. So they need to leave the door open and not look like they're just being cut and dry about it and done entirely. There also hasn't been a big reason for them to be done verbally, right? We haven't had this terrible slowing in growth yet. We had 4.9% GDP in the third quarter. So there hasn't really been a slowing in some of that economic data that they point to, which is the labor market and growth. So there's not a reason for them to say that yet. I actually think markets would hear that with a bad ear and not enjoy the idea that they had given up at 3.7%. So again, and I've mentioned this before too, if you look at their own projections, even the Fed is projecting that core PCE stays at this same level through the end of the year. So they're not even expecting that much more cooling in inflation over the next 2 months, which I think makes perfect sense about why they would leave the door open. The other thing I would say, and we can look at this in the note too, I had a section in there that was labeled 2% means 2%. He continues to reiterate they have not considered raising the inflation target, yet market participants continue to speculate that they're going to. And I think we need to listen to him that they're going to either sound hawkish or be more hawkish until and unless that inflation target comes closer into view. So I don't think that we're completely out of the woods yet, but I agree with many people out there that it's looking more and more like July was the last one.
Yahoo, I saw Jamie Dimon. We run, and this is his quote. We run the company, JP Morgan, so that if there's a 7 or 8% long bond rates, we're going to be fine. We're not guessing for it, but we stress for it. So think about that. I mean, this is consistent with some of the things he said. He also thought that inflation would be stickier, to your point. Again, this is the most important banker in the world, making comments somewhat contra to what the market is obviously displaying today. Again, I will tell you, a lot of this move feels like a bit of a massive unwind. Maybe the entire hedge fund community and other people got themselves over their skis in terms of being short bonds and some of the other things. And I think there's an unwind going on. But to Liz's point, Dan, I don't think we're out of the woods yet at all in terms of everything she just said, that 2% level being somewhat steadfast in the line in the sand.
Well, and to go back to the Rosie conversation too, I mean, again, he thinks rates go lower, you think higher. Look at where the TLT is. Okay, so the TLT was trading above 87 this morning. It's trading 86.30, so it's down. It's trading at the lows of the day. Our friend Doug Cass points that out to us, and I think that is really interesting because what Rosie's point was like, listen, this bond trade, okay, everybody followed, Bill Ackman into the short yield trade, or excuse me, the long yield trade, and he actually took that trade off a couple weeks ago or something like that. And Rosie made the point, everyone's going to follow him there too, right? At least if you're set up that way. But Rosie also made the point, without giving too much of it out, because you got to go listen to this thing, is that like a big point in the bond short was in the futures, in the options. Okay. So I thought that was kind of interesting. So we'll check that out. Liz, what do you make of this? Because if you just look at this chart and you take the TLT name off of it, right? And you look at that decline, you look at how it's been consolidating, at multi-year lows here, and you see that sort of gap today, but now it's kind of giving, if they could put the day chart on there, it's giving all that back. What does that tell you about the like where near-term rates, might go, after such a big move?
Well, the funny part is if you put that chart up and took the name off, I'd think it was a tech stock. And yields are not supposed to move this way. So take the 20 plus year out of this, even just look at what's happening with 2s and 10s. It's called a bull flattener when the 10-year yield falls faster than the 2-year yield. But don't be fooled by the name. The 10-year yield coming down faster than the 2-year is not bullish. That's usually signaling that there's some kind of concern over the economic prospects going forward. So maybe not something that stocks will react to negatively in the moment, but the look out ahead 6 to 12 months is not promising when that's going on. The 2-year yield being stuck where it is still signals that the market is listening to the Fed and that they're not coming off the gas anytime soon. We haven't priced in a cut until at least July of next year, maybe not until early in fall or later into summer. So I happen to think they might have to cut long before the market thinks they do. But the movement in yields, number one, just broad brush strokes, the volatility that we're seeing is not normal and is not healthy. And the movement in yields and the difference between not only the spread between the 2s and the 10s, but the speed that the 10-year has fallen, regardless of what Bill Ackman has said, the speed that the 10-year has fallen doesn't really send good signals about economic prospects going forward.
No doubt. And let's pull up that 2-day TLT again with that gap. Okay. So Guy, question for you. If tomorrow we have hot jobs data,
right?
Okay. And we fill in that gap, okay, that means yields go back higher. S&P's down 60 handles.
Well,
I'm just telling you, on a Friday, they're down like that. I mean, like they're
understanding.
Giving it all back.
I agree. Understanding that Apple can mitigate that to a certain degree, but if you get, let's just play it out. If you get a mid to sort of disappointing Apple release, the stock is nowhere, and then you get that jobs report that you suggest, that makes sense given the move. I mean, think about the move we've seen in the last 4 or 5 trading days just in the S&P alone. It's pretty remarkable. So Elizabeth's point is spot on. It's not a healthy sign to see the bond market move this way. And you can say people followed Ackman in. I'm sure a lot of people were in it long before he was number one. He happened to mention it, obviously, in the beginning of August, and the trade was spectacular. I mean, when he announced that trade, I think 10-year yields were 4.18. Over the next couple of days, they traded below 4%, so it seemingly had rung the bell. And then obviously they were off to the races, and his basically exit of the trade was a top tick in terms of yields. Good for him, good trade, check changes, they say. But I don't think any of this is necessarily over. But the important point to take away, moves in the 10-year of this magnitude to the downside do not suggest economic strength. It's actually anything but.
So Liz just said it. Liz, you said you think okay, that the Fed is going to have to lower interest rates long, isn't this, I'm quoting you accurately, long before what market expectations are right now. And I want to go to a chart here that our team put together. And again, this might make some sense to you. It might make, it might not. 30 years, if you just look at the Fed funds rate, okay, and you see that. So what I really wanted to focus on mostly is that periods in which rates were going higher, right? So if you go all the way back into 2000, the Fed stopped raising rates early in 2000 or in the first half of the year. And then if you look at the lag, they didn't basically cut rates until January of 2021. Well, the S&P had topped out and to its lows in 2002, okay, dropped, I think, 58% or something like that, or, got cut in half basically. And then the Fed started raising interest rates again, fairly aggressively after they got pretty low during that protracted bear market and that recession. And then into the mid 2000s, and you see they stopped raising interest rates. And I think in late 06, and you see the big lag, they kept them, higher for longer. These are themes these are names in terms that we've heard before. But then look what happened. They had to start cutting interest rates, obviously in 2007, 2008, and they got to that zero interest rate bound. The S&P got cut in half again. Okay, well, you see, Fed Chair Powell comes in 17. They want to start normalizing interest rates. What happens? The stock market drops 20% in a straight line. We see they stop. Okay, then the black swan event. So you see what I'm getting at here, right? So if Rosie told us that the average period from when the Fed stops raising interest rates to cutting interest rates is about 10 months or so, okay,
puts us at May.
Yeah. Well, there you go. See that? But do you think that's useful or not, Guy? Because you can go back and you can say, well, the Fed was raising interest rates back, in the early 90s. They stopped that sort of thing, but the market kept on going. That's just one instance in like 5 over the last 30 years.
Well, I mean, if you look at the S&P is obviously the consistent blue line, lower left, upper right. And if you look at sort of the sell-offs, they come in the wake of these moves higher in yield. So I'm surprised. Again, I will continue to say I'm shocked we haven't seen the downdraft that you've seen historically with rate moves of that magnitude, but it doesn't mean it's not going to happen.
Liz, what do you make of this? And again, what are we trying to focus on here? We're trying to focus on the last handful of times over our lifetime in the markets here where the Fed has embarked on aggressive rate cutting, stopped, and then ultimately every single time it results in aggressive, rate cutting, you know what I mean, after those periods of hikes. And so, if a lot of folks are basically like saying, okay, well, we got the recession call wrong for 2023, right? But it's likely to come in 2024. And then when you think of just all the different sorts of pockets of risk in the system, you have all this kind of private credit. There's a whole host of things that we are not even talking about yet. Like, I guarantee you, okay, when we start to have some bankruptcies that actually make it to the front page of the Wall Street Journal and some other instances, and we start seeing, like really hits to the consumer in a way where savings rate is really low and credit card debt's at all-time high and the revolving rates, you know what I mean? Like, we are going to have so many things to talk about. And I'm not like looking forward to like some sort of calamity by any means, but like, it's coming and rates are this high and they're likely to go much lower than when that happens. So is that a good time to start buying equities? I don't think so.
Okay, there's a lot there. Let me slice through this a little bit. So first of all, something happening later is different than something happening never. So yes, if people were calling for a recession in 2023, wrong. And I've been one of them worried about it happening in 2023. So that's been a wrong call. Does that mean that I change my mind and say, you know what, because it didn't happen this year, it's never going to happen? No, I think that this cycle is, as we all know, longer than what we're used to. That chart of the Fed funds rate and the market, it's not, you don't even have to just use our careers, right? Our recent past to think about this conceptually. So you can see in this, and even if you take it back further, you can see that when they raise rates, it seems to take more of an elevator, except for perhaps this time. It seems to take more of an elevator up, and it goes down really, I'm sorry, escalator up, elevator down. Goes down really, really fast. Conceptually, why does that happen? It happens because as the Fed starts raising rates, they are almost always doing that because the economy is hot. They're doing it because things feel good. Demand is strong. It's outstripping supply. Inflation is rising. We're late cycle. That is the definition of them trying to constrict capital in the economy because it's starting to overheat. They stop raising rates when it has stopped overheating, and then things start to turn around. The difference right now is that I think there are a larger number of market participants hoping that they can somehow also take the escalator back down and normalize rates without anything going terribly wrong. And Dan, to your point, there will be a lot to talk about, but one of the things, and I know I've mentioned this before on this show and on the pod, one of the things I try to think about really often is, if I look back on this period 6 to 12 months from now, how obvious is it going to seem that that was going to happen? So let's say we do have some kind of drawdown. Let's say we do have a recession. All of the indicators that you just mentioned, all of the things that we watch. I mean, PMIs this week were pretty bad. We've got 3 quarters strung together of negative earnings growth. We've got consumer credit card debt. I mean, the list goes on of things that haven't broken it yet, but are out there as concerns. If we look back on this period 6 to 12 months from now and say, oh, that's where it was, I think it will be pretty obvious that there was stress in the system and there were things waiting to turn in the other direction.
Yeah, fair enough. Okay, going around the horn here, let's just do this to kind of put a pin in this whole thing. So, Guy, equities here. Obviously, we got to wait and see what happens with Apple. Okay, but if Apple is, let's say it's not as bad as expected, and I think we can all agree that sentiment's really poor as it relates to Apple right now. Okay, whether it's China, whether it's iPhone 15 demand, whether it's reshoring, whether it's whatever. Okay, so if equities were to move higher based on Apple, you get a continuation. You're not chasing it, right?
I don't think so. I mean, we'll go back to that original chart, that down channel of the S&P. I mean, maybe we get to the upper end of that down channel. I don't think you chase. No, there you are.
Yeah. So you and I are in that camp, Liz, that we would be fading the S&P. I don't have an equity index short on right now. I think all of us were pretty clear. Liz, you and I started the week out on Monday on the tape. We thought things felt a little bit overdone to the downside in the very near term, especially in front of a big week of earnings in the Fed. And here we are. We've had that bounce. I would be looking for an opportunity to kind of sell the S&P or the NASDAQ. What is your thought? This would be more in the near term. And then I want to just kind of like put a pin on the bond move.
Yeah, well, first of all, I don't short equities. I just want to make that clear to everybody. The thing that I would do along that vein is I sometimes go long the VIX if I think that there's going to be a spike in volatility. So I don't short equities, but yes, I would say that I think this is an opportunity. If there's stuff in the portfolio that you wish you would have sold before that last downdraft, this is an opportunity to finally unload it and make sure that you've got risk at a comfortable level. That being said, I also want to make sure that it's clear. I'm not saying get out of the market entirely. I do think that you can still hold and even build defensive positions. Utilities was the best performing sector in October. And I think we're going to see some of those defensive sectors still do okay, even if we have stress. I also think we're going to see yields come down further. So yes, I think this is a good opportunity to get rid of any risk that you wish you weren't holding and make sure that you either put it in something that's earning a yield so you get paid while you wait, or rotate into some sort of defensive sector positioning.
Yeah. And people say, Guy, we don't buy anything. We did a market call, I want to say 3 weeks ago, and we detailed some bullish trades that I was doing in the XLP and the XLU. I mean, to me, they looked very overdone. And if they can pull up this XLP chart, Guy, this thing, I think, still gets back to the breakdown level, like 71 or so. So I think there's another sort of 5% there. I know that you were in agreement. So I agree with what Liz is saying on the defensive front, and especially with what's been done to valuations. All right, Guy, as far as yields in the near term, what do we think here? Because, again, obviously a lot has to do with what happens tomorrow. But thoughts on, this move from 5% to 4.63 or whatever the hell we are right now. How do you trade the TLT right now?
I mean, we talked about it with Carter earlier in the week. I thought 88.5. I think we got up to 87.30 or so today in the TLT-ish. No, I don't know. I mean, to be honest with you, I'm not sure. Maybe 8.5 is right. That probably coincides with 4.55 or so. It all lines up with sort of the channels that we've outlined over the course of a lot of time. So that would make sense. And we're looking at, I think, a TLT chart right there. So, maybe 88.5, 89, which again makes yields 10 years, 4.55-ish. Then it makes sense, I think, to look for yields to go higher again.
All right, let's do this. This is the time, other than when Liz joins us on the Thursday market call, where Guy gets probably most excited here. And
somebody gave me a heads up on this last night on Twitter, by the way.
Really? What?
Yeah, because somebody on Twitter, I think it might have been Jay Sloan or somebody said that,
Jay.
Do you think Guy has any Wilson Phillips songs on his Spotify playlist? And of course, we all know the answer.
I mean, Liz crushed that. We actually just skated by the title, but we just thought there's so much going on here, Liz. We wanted to kind of, there she is.
Nobody
there.
likes
Yeah.
Wilson Phillips. The people in Bridesmaids didn't like Wilson Phillips.
Oh, that was such a good scene, though.
That was a good scene.
I've
I
never
Such a
seen
good
that
scene.
movie.
And
I
the
heard that was
drums, the
Bridesmaids.
drums
I
that
heard
they
one
did.
of the best comedies of like this, this last 10 years. or something like that.
Bridesmaids. I mean, there are a
I
number
love
of
that Kristen
scenes.
Wiig. She's
hysterical.
She's
Yeah,
great.
she's great.
There's a scene when they go to the gown boutique.
Yes.
You recall they had just had sort of a luncheon at a sort of a sketch place, and let's just say their constitutions didn't hold up particularly well.
All right, I'm gonna have to go to the
Elizabeth?
YouTube.
That movie was it was either filmed or it was intended to take place in Milwaukee, Wisconsin.
Sure it was.
Oh yeah.
Fun fact.
All right, let's get to John Butters. He is the senior earnings insight analyst over there at FactSet. He actually puts out his earnings insight blog every Friday morning. It can be in your inbox, but we get a preview of it on Thursday's market call. And I think it's an interesting day to be hitting this sort of data, and we're going to show you why. The market is punishing positive and negative EPS surprises more than average for Q3. The S&P 500 companies reporting positive EPS surprises have seen an average price decrease of 0.4%, which is smaller than the 5-year average of 0.9% gain. S&P 500 companies reporting negative EPS surprises have seen an average price decrease of 5.8%, which is larger than the 5-year average of 2.3%. These price reactions may be related to lower expectations for Q4 as EPS guidance and estimate revisions for Q4 have been more negative than average. And I just want to pull up a slide today of some of the biggest movers after earnings. And this kind of flies in the face a little bit of this data. But look at what's going on. Now, here's another theme, Liz, that I want to kind of talk about with this right here. So when you're seeing a Roku down, which is up 90% of the year, up as much as it is 30%, a Shopify. Okay. These were the names that were out of the gates. They were just screaming. They got absolutely destroyed last year when interest rates started going up. And we know why. So my question to you is, yes, expectations were low despite these stocks being up a lot in the year, but they beat those expectations. Then you throw in the yield move that we have today and the broader move in equities, and we're YOLOing. It's, everything's back on. Talk to me about Butters data and then what this says to you just today.
Okay, so obviously I'm not going to talk about any of those companies in particular. I do think the yield move has a lot to do with it. I also think that a lot of this rally this week has been some short covering. And if we think that this is a quarter where we're going to see some of the last good results, or that maybe fourth quarter isn't going to be as good as we hoped before, maybe there's people trying to make sure that they don't end up on the wrong side. Who knows, right? I think more the interesting part of earnings season this time is that you've seen revisions come down. Now, we've said over and over again, it's too high for 2024. It's even too high for Q4. We've seen earnings revisions downward now of 5% for Q4. That's a big move. So the guidance has not been kind to a lot of stocks. And I would wait to lock in some of those gains or assume that those gains are going to stick around until maybe this yield move calms down a bit, because I'm not sold that only a handful of stocks will act differently than the rest of the market. And we're pretty far through earnings season. We're about 70% reported. So this would be a theme that stood out, that suddenly these stocks got handsomely rewarded. It could stick, but I'm skeptical.
Yeah, I mean, if this, for example, I'll just cherry pick Roku, and you look at the move today, and you look at the move over the last couple of weeks, you're like, holy shit, look at this thing. Then you go back 10 years and you look at sort of the last year and a half, 2 years. I mean, that's a dramatic move. But if we were to broaden this out even farther than that, you will see a stock that's basically gone nowhere and even go back, keep going back and back and back. And you'll see you've had these moves to the upside, but it's all, I do think it's all interest rate related. So yes, over the course of a couple of days, it looks remarkable. But over the longer term, I mean, we're effectively nowhere in so many of these names.
So this is pretty amazing. Let's go to a 1-year chart for a second and then go to a 5-year chart. So to see this 30% gain, okay, the stock is still down 84% from its all-time highs made in 2021, okay? And the death rattle for the stock, when you look at that double top that we see, was basically when the Fed said that they're going to start raising interest rates. So all these sorts of companies that, were trading at ridiculous multiples, just absolutely got killed. So just to put that in some context, I mean, even with today's gain, the stock is still down 84% from its all-time highs. You may say, well, why do you care about where it was 2 years ago? Well, listen, our our memory of these sorts of stocks and those sorts of periods, that some of these stocks will never, ever, ever go back to those levels. So I don't know. All right, Liz, we appreciate you being with us here on a Thursday. You're going to be back with Guy Adami on the Tape podcast Monday morning. So people go check that out, and you're going to get everything that Liz has to offer to set you up for the trading week next week.
It's a great way to start the week.
It really is.
It's like bright and early, bang.
Bang.
Yep.
Thanks, Liz. Have a great
Yep.
weekend. There
Thank
you go.
you.
You can go to the SoFi.com/blog and you can get Liz's blog post.
You should.
Yeah,
I mean, I don't know if you haven't been doing it. I don't know
where
under a
they've been.
rock.
Well,
Or
you
something.
used to say
know
that if you're not following Liz on
You're
Twitter
doing it wrong.
at Liz Young Strat, you're doing Twitter wrong.
Either that or you've been spending too much time at Starbucks. Look at this chart.
All right,
I
let's
mean,
do it. Look at
this is
that.
you like that?
Good segue.
Oh,
I see what
appreciate
did you
that.
have a Starbucks today? I don't know.
No,
Really?
I don't get myself Starbucks.
You get other people Starbucks.
No.
We talked about that yesterday. on
I
MRKT
go
Call.
in. I know the people there, but I never get myself.
All right, so
there.
let's talk about this. This is actually really interesting juxtaposition. All right, guys, throw up that list of all those stocks that are raging today after earnings, okay? And then if you look at like a Starbucks, one of the reasons why we didn't throw Starbucks as 10% move on there is just because in market cap terms, it's much bigger. I think Dash is a pretty decent sized market cap, the guy. So let's go back to the Starbucks here. To see a move like of 10% in a Starbucks
doesn't happen.
No, it doesn't happen too often.
No.
So
I mean,
what was your takeaway on this?
Well,
one?
I mean, I think, look, first of all, I didn't see this happening either. Let's just be crystal clear. I think there was obviously, I think China concerned a lot of people for good, but you know, if you come out and say the things that they said and people are now buying pricier, higher margin things, if people are on the wrong side of I mean, this looks remarkably similar to what we're seeing in the bond market. You know, everybody on one side of the equation, everybody wrong, and then everybody covering seemingly at the same time. I'm just pulling up the amount of volume Starbucks has traded today. You know, it's traded 12 million shares already, which is more than 2 times normal volume at 1:30 in the afternoon, which means we're probably going to trade 3.5 times normal volume. Do you get up to that sort of, I don't know, maybe 105-ish level, which was that recent high? Yeah, maybe we push up to there. But then again, you say valuation's a concern again. So the valuation trap hasn't been fixed. It's just been pushed off, I think.
So interesting on the valuation front. I'm looking at a stock of Starbucks that trades at about 24 times this year, about 21 times next. Okay. That's basically in line with McDonald's. McDonald's is expected to have much lower EPS growth on the out year, okay, 6% or so. And I think Starbucks is expected to have, I don't know, something in the lines of 12% or something like that. I look at their margins, okay. You know, McDonald's, you know, their gross margins are about 58% versus a Starbucks is at 68% or something like that. So I say to myself, you know what? There's been a few turns taken off this from a multiple standpoint. It changed kind of cheap relative to his historical. It's always traded at like a, you know, a premium to the market and many of its peers. I don't know. Maybe it's fine. I'm not saying to buy it up 10% or something like that. But again, this is a theme, Guy. You and I have hit a bunch. We probably traded less names in and around earnings this quarter because we were more interested in to hear what they had to say and the confidence in their visibility. And then that will help us kind of set the stage for into year end and into the new year. So as we're getting through, let's say 3/4 of earnings season, you know, like Apple, like again, I think this is going to be the one. It's going to be like the pièce de résistance.
Yeah, that no question. That Nvidia in a couple, well, more than a few weeks now. I mean, that's obviously going to tell a tale. But Apple, that's what everybody's waiting for. And I have no idea. It got down to 165. I thought it could get down to 161. I don't know if that's close enough. Now we're at sort of, if you look, that downtrend line, we're right at like many things. That downtrend line is still intact from July. Do we break through it and do we go raging higher? Well, we're going to find out. I mean, I guess it comes down to services. If services are somehow, I don't know, 22% of overall revenue, maybe the market then re-rates them in terms of valuation. I just don't see it happening.
All right. So let's just technically we see that. We see where it bounced. The implied move in the options market is just below 4%. And I'm looking at the money straddle in the weekly. That's tomorrow's expiration, the 177.5 straddle. That'd be the call premium plus the put premium. It's basically about $6.50. Okay. So if you just wanted to, again, we talked about this a little bit yesterday. The 177.5 puts are offered at $3.30. Okay. So that's basically less than, 2% of the stock price. I mean, that's probably a cheap way to make that bet. If you thought the stock is going to actually beat and raise, which the street does not expect to happen, and it could have like a 5+% move, then paying a little less than 2% for a breakout, you know what I mean? Your break even's up at that 180 level, which is the prior high from just last month or something like that. That's not a bad way to do it. So usually at this stage of the earnings season, I don't think we could look at a name like Apple, which is obviously like a battleground sort of stock in this market, and say there are cheap ways to pick a direction into the print, guy.
There are no right now. I mean, that is the cheapest it gets.
That's what I'm saying. So like that's kind of really odd to me. So if you had conviction one way or another, I think playing it through options.
Look, I mean, $3.50, right? So 174, you break even. You're going to start to, if in fact that's what transpires, the stock goes lower. Vol's going to start to work in your favor. I mean, it is a cheap way to express a negative view in the stock post earnings.
Yeah. All right. Well, listen, I just want to mention one other name, and that would be the Tesla guy. This is one that I think is kind of interesting because there's a guy on the Twitter who was actually on CNBC's Fast Money with us. He's a big bull. His name is Gary Black. He's actually a very smart guy, very thorough guy. He's bullish when the stock's going up. He's bullish when it's going down on the stock. He's actually had some interesting things to say about the fundamentals and the company's strategy, which flies in the face of someone who's a staunch bull. But you can just look at that, guy. So look where it stopped. It stopped basically at the breakout level from the spring, that cluster of the highs late last year. You know, it's basically stopped where it should have. So one of the reasons that I find this interesting, let's see how a stock like this closes. Let's see what sort of follow through. I think that it's going to be testing last week's lows in the not so distant future, because I don't think that this interest rate move, while Elon Musk has spent a lot of time focused on higher interest rate and what it means to finance the cars, I think it has something more to do with the fundamentals of this company that have been deteriorating all year. But again, I just wanted to bring that up. That's a big move, 5.5%. People are piling back into it, but it was also down 30%, I think, at its recent lows from those highs.
Not coincidence that his yields have gone lower. Actually, I mean, if you think about it, Elon Musk probably top tick rates in terms of some of the commentary he made about rates being detrimental to their business, and the stock has bounced since. So it does make sense. Could you fill that little gap that we see sort of on, if you look over right at the end of the chart? Yeah, I guess maybe if this tape continues, but I'm sort of with you on this one. This is going to start to get long in the tooth as well.
I got one other thing. Let's pull up Amazon really quickly. Okay, this stock went up in a straight line here. I'm looking at a put spread. I want to look at December expiration in this one. Look at this parabolic move since its earnings here. And I want to look at the December, probably like the 135, 120 guy. What do you think about those levels as I pull up the prices? As I pull up the prices here, and I look at those kind of 135s in deck, they're offered at 430. Okay, and so I'm paying 430. If you're buying the 145 or 135 and you're paying 430, your break even is down just below 131. But I almost want to turn that into a put spread by selling the 120 at like $1. So I would have a 15 wide, the December 135 120 put spread, paying about $3 for that. That would break even at 132, and you can make up to $12 between 132 and 120 on December expiration. That's a pretty good risk reward.
Yeah, I think so. And you're getting paid enough, I think, on the 120 puts that you're selling to sort of do that. And then you get sort of, you have a defined risk, and you're basically saying, you know what, I'd be willing to buy a stock at a certain level, which I think it all makes sense. I mean, that's a trade where, you're taking some of the premium off by selling the 120s, and it actually, you probably get that sweet spot somewhere around 123 to 125 is my sense.
Yeah, and just to be clear, I was just quoting the December 22nd, so I might give it another week there a little bit. But either way, looking to basically pay about $3 for a put spread that would capture, let's say, about 10% of the move lower in this thing with a break even down a few percent. So Amazon's one that is on my radar and be looking to do that. All right, guy, we covered a lot of ground here.
A lot of ground. Apple today. Good luck with that. We'll be on Fast Money.
Yeah,
Stuart Sopp from Current's going to be joining us. Check out our podcast, which drops at your favorite podcast store on Fridays.
That'll be the On the Tape podcast. David Rosenberg, Danny Moses. We had a great conversation. So
we did. That'll be good. And check us out on the gram.
Oh, yeah. Wait, what are you? Your guy dot Are they going to have a graphic for us? I thought we were working on a graphic.
There you go.
Oh, look
at
that.
It.
Look at that. Look
Dan S. Nathan, risk reversal.
Wait, who's that guy in the middle?
I don't know. Does he?
Oh, that's Mark Zuckerberg. So
He works with us.
No,
now?
we're just hanging out with Zuck. So I am Dan S. Nathan.
Mhm.
We're going to put a lot of content. We're going to start really jamming our Instagram. And Guy, you're Guy.
Are we allowed to do that? I mean, was he going to get mad at us?
No, he's fine. Look at
We
we have him smiling. He looks better than we do up there.
We
Don't you
get,
think so?
I mean, people get kicked off of things for less.
Oh, I got kicked off of Twitter for less. Yeah. So then definitely also follow our Risk Reversal Media Instagram. So it's Guy.Adami, Dan S. Nathan, Risk Reversal Media. We're on the Insta with Mark Zuckerberg.
Check it out, peeps.
All right.
We'll see ya later.